fraud's going to become the number one discussion topic for banks. Fintech funding is...
Fun episode today. We have Zach, founder of Plaid, giving us his 2025 Fintech predictions, and we're doing it game show style. I'll be moderating as well as sharing some of my own opinions. And we also have joining us Plaid's new president, Jen Taylor.
Deep fakes in the fintech sector are up 700% year over year in 2023.
As well as their longtime head of policy, John Pitts.
I actually don't think this is a fraud problem. I think this is a problem at the end of the day.
We're going to cover a lot of topics, so let's dive right in.
That's over to me. Actually, kick it off now for Jeff. So I'm excited. I'll be hosting and refereeing this game show style predictions with Zach. We've got 45 minutes. Should be a lot of fun.
All right. So my first prediction is that fraud is a huge topic of conversation. Fraud's going to become the number one discussion topic for banks. It's actually going to surpass the regulators and regulation in terms of what they're thinking about day to day. So fraud is kind of like rising to the top. Context for this is, as you see kind of in the news every day, financial fraud is at an all-time high. We hear it kind of coming from Zelle, and you've seen a lot of that in the news. We hear it coming from crypto land, and you've seen a lot of that in the news. When I talk to the financial institutions, when I talk to the banks, the thing that they always say is, hey, can you help me? I would love better and new and different fraud products. So fraud becomes the number one discussion topic for the financial institutions and the industry more broadly.
I agree, but I think it's a softball because I would say it is almost a statement of fact versus a prediction. But, it will get probably worse before it gets better. Losses, $23 billion in 2023, about $1 trillion globally if the numbers are to be believed. Average consumer, when they are impacted, $3,000. So these are pretty material. And to your point, Zach, around Zelle has been growing in transaction volumes, but that meant headlines started coming out. Hey, Zelle is facilitating fraud. Anytime you start scaling products, you start getting hit by fraud. Banks feel that just like fintechs feel that. But I know we've got some good opinions from Jen and John on this as well.
Yeah, I mean, completely agree. Fraud is the number one concern I hear with customers, with prospects of all size and ilk. Frankly, as finance goes digital, fraud's going to follow, and Rex kind of touched on some of the high points that we're seeing in terms of watermarks of impact of fraud, but it's really kind of across every dimension, right? Like deep fakes in the fintech sector are up 700% year over year in 2023. AI tools are getting better and better at doing that. You also have first party fraud, and that's costing us about $100 billion annually. Like it's just kind of coming in from every angle. But the good news is that like there is stuff we as an industry can do about it. At Plaid, we think about it as the challenges our customers face is they don't know who they don't know when somebody shows up to join an organization or to onboard, or once that person's within the context of the four walls of the organization, they don't understand that person as an actor or other signals of kind of how they behave. And that's really kind of how we've thought about tackling it. First and foremost, obviously, we provide things like liveness checks, and we're seeing that up almost 40% year over year in terms of usage by our customers. But we're also building security and fraud mitigation into our products, into our onboarding products. Layer was a huge part there. But fundamentally, we believe that fighting fraud is a team sport, and so we've been standing up Beacon, which is our fraud consortium that enables people to share those insights and leverage them globally, so that we really can have that sort of multi-pronged attack as an industry.
So I use the fact that I had two paddles to put up both.
How did you get two paddles? What's going on?
I always have multiple paddles, Zach. That's my hack every year I've got the CEO and the president. The most I can do is just have an extra paddle to make myself seem relevant here. So listen, this prediction is partly right, partly wrong. It's partly wrong because it's not a this in the future thing. This is a prediction for 2024, Zach. This is already the number one topic for banks. And there's a couple of ways you can tell, right? You are seeing not just the Zelle lawsuit that you referenced. By the way, that was $870 million of alleged consumer loss from one institution. The CFPB also sued 3 of the owner banks of Zelle, household names, saying you all are liable for this also. You've got the clear indication that this is going to be a major issue, if it's not already one, in that the Aspen Institute has spun up a major anti-fraud initiative that the largest banks, as well as Meta and, in fact, Plaid, are participating in to try and drive fraud out of the ecosystem from a think tank level. Whenever the think tanks are involved, this is like meat and potatoes of the legislative and policy and business agenda for the next year. The last thing I'd say, though, in terms of why I slightly disagree with this is not to be like too persnickety about this. I actually don't think this is a fraud problem. I think this is an identity problem at the end of the day, right? Where like once you get into it, there's one single thing that every fraudster has in common. They have a bank account, right? And that means that they've been able to move from account to account, even though they've committed fraud multiple times, because there's no good identity information sharing to block someone from getting past KYC when they're a fraudster and when they've gotten past it at some other institution. So someone in chat asked, do I think this is going to get better under the Trump administration or not? I'm actually optimistic because one of the tensions we've had over time is a general sense of like everyone should have a bank account. And if you say that everyone should have a bank account, you also mean fraudsters should have bank accounts. I think this administration might have an opportunity for us to do something that moves a little bit more in the direction of federated identity and also the ability to keep bad actors from opening account after account after account by blocking them out of the system. So I think this is an identity issue, not a fraud issue, but I do agree it's going to be number one, and it has been number one.
Yeah, are you implying that the only solution here is a kind of government mandated one, or do you think industry can independently solve something?
I think this is a private sector solution, not a government solution. I think most Americans do not want the government to tell them who they are. They want to tell the government who they are.
I think the government can fix this problem, has made great strides in places like India and Brazil with their identity layer, especially in India. But I think the U.S. populace is kind of just allergic to the idea of government owning identity in super material ways. We also have a federalist system with 50 states and independent DMVs. So it's hard for the government to do it. Also, we haven't done it. Like you couldn't log into the IRS until 2019, I think. And so we're going to have to do it. So good news is, if you want to be part of the solution, you can be part of the solution. Bad news is we haven't built it from day one as a country.
You know, one of the most fun things that we actually we launched recently was, in fraud detection, there's this product called Email Age, which is very simple. It tells you the age of the email address. So how long has this email address been around? And we built a feature called Account Age. So like how long has this bank account been around? And it was something that we could uniquely build because we'd seen a lot of these bank accounts a long time ago at Plaid. And was transformational in the way that a bunch of our customers were using that. So I still think that there's a lot of these low-hanging fruit solutions that, a very basic data point can actually meaningfully affect the trajectory of fraud.
And it's amazing. It's amazing how hard it is for some people to get those signals, right? And that's where I think it really comes to private sector solutions to be able to sort of harness those and actually show them in a way that people can consume in like an easy and standardized way.
And if we're lucky, hopefully we'll create new problems. Like we didn't have the credit bureaus for a long time. So it's like, how do I lend to people? Then we create the credit bureaus. And then the complaint is there are all these thin file consumers out there and they get treated poorly, even though they're great. So maybe in 5 years, we'll have solved this problem. And then people will be like, well, I'm a thin data, person because I just opened my first bank account. But yeah, if you want to work on a problem, this is a problem you can be part of. Beacon is part of that. There are other initiatives as well. But let's jump on to number 2. So Zach, what's your number 2 state of fintech prediction?
All right. So my feedback from number 1 was that it was a boring prediction. So let's see if number 2 is a little bit less boring. So prediction number 2 is that there's going to be lots of AI hype, but it's mostly just hype. In 2025, I'm thinking that a lot of the fintechs are going to invest in AI tools to increase productivity and employee efficiency. And so in as much as fintech companies are saying that they're going to be using AI, I think that'll absolutely be true, but it'll mostly be for internal purposes. But from a customer-facing product standpoint, I think there's going to be relatively little impact. There's going to be lots of people talking about things like AI personalization or AI-driven investment portfolios or kind of AI-driven wealth managers, so much more. But I think the reality is very few customer-facing products are actually going to be launched. So really, it's more hype than actually substance.
I agree. I mean, honestly, like AI is all about the back office. Like, let's look at the headlines from 2024, like Klarna chatbot doing the work of 700 agents. Like BBVA has, 2,900 GPTs created by staff that are like running the business. Like, I think, you're going to continue to see that sort of marginal, sort of on the margin business. Like, it's going to make the human to human interaction probably more focused. But yeah, it's just back office. And the reason is that like, I think there's some structural challenges around AI. I mean, the first is just like data access and data privacy. Like when you're talking about identity information, financial information, there's lots of concerns and regulations as to how people access and actually work with that data. Then how that data gets integrated into models is also of concern, and that's going to need kind of a lot of inspection. But then there's also the final reality of like data is like hard for people. Everybody's like, I got lots of data, but like data is like herding cats. It's like hiding in these silos, like spread across the organization. And so being able to like inventory, figure out if the data is any good and actually integrate it into a model that is powerful and delivering value in a generative way externally, it's just going to take time.
I'm also all on this hype train. I've spent several years saying a lot of crypto stuff is hype. Stay tuned for that on a later question, potentially. I think this is the hype on this one, right? Like, I was in a Canadian meeting a couple of months ago, Chatham House rules, so I can't name names, but a fintech CEO told a story about, once ChatGPT was out, messaging everyone and saying, I see that only 80% of people at this company are using ChatGPT. If you're not using ChatGPT by the end of the month, you're fired, right? And a bank CEO in the same meeting spoke up and said, oh, actually, we just sent out something reminding everyone at our bank that if you use ChatGPT, you're fired. Right. So like this is the world of like regulatory hurdles. And it was a great moment. I think this is really hyped because the second you start applying this to anything significant, not just back office stuff, but decisioning, like making a lending decision for a consumer, deciding how you are going to handle even like a customer complaint where you get something wrong. Like the Zelle lawsuit I mentioned in the last question, a lot of that was like your customer complaint people didn't do a good job. And now you're going to hand it over to an AI that also might mess up, but might mess up at scale in a way that is filled with hallucinations and is not fully explainable. I think until you get this thing enterprise ready and then enterprise ready for financial services, which is another step further, you are not going to see wide adoption in a way that significantly moves the needle in the financial services industry.
Well, wait, can I add a question here? When are we going to see meaningful consumer facing adoption? So, I mean, Rex, continue, but maybe we can
this is where I'll push back a little bit. Like, yes, I agree. You're not going to see a bank launch a huge new consumer facing AI product. They do have their chats and that'll probably get marginally better. But also, who cares? Who cares if it's only back office stuff? And it's not hype because, and Jen, this kind of gets what you're talking about. Even if you don't do the AI, every single executive team at every large institution, public, private bank, beyond, they now know they actually have to get their data lake and their data infrastructure in order. And this has been a huge accelerant for everyone to just get their data warehouses working, which if you work at a fintech company or startup, you're like, what's the big deal? If you work at a massive bank, you've been on like a 10-year journey trying to get your data in one place. And now every single C-level leader is bought into the idea that you have to have the data because data is going to be the fuel for these things. Two, and this is your question, Zach, timelines. Banks are really, really slow to adopt things, as are other incumbents generally. I don't know what it is, but something about AI, it's just happening faster. And maybe it's because people have learned that like tech is a thing and you have to wake up when their platform shifts. But if you look at a cloud migration for a core banking system for JPM, they did in 2021 with Thought Machine. This is 15 years after the advent of AWS. If you look at Morgan Stanley implementing an AI tool that's pretty thin, it's like a note taker for their wealth management agents. They rolled out to 100% of wealth management agents in less than a year. That is warp speed in enterprise time. So even if you don't see material adoption, and certainly not a consumer product, it's amazing to see the extent to which people are actually taking this seriously, building out data warehouses, data pipelines, are actually experimenting with these tools. I have a funny anecdote. I interviewed Josh Brown as a CI, or one of the founders of a relatively innovative RIA firm, and he was a stockbroker in the 90s. And he's like, hey, the first email or first company announcement about email that we got was, we'll never have an email account. And then it was like, we'll have one, but you can't do it. And then eventually it was. So, and this is just happening way faster. So that's my little bit of pushback is like, it is happening faster. Also, big winner is Sebastian at Klarna because he just drove home a PR message. And so, Zach, I don't know what you were doing. You need to work on your AI PR messaging to just own the moment because Sebastian, that's a W for Sebastian.
He certainly won the PR messaging around AI usage. All right, Jen, when are we going to see consumer products that really leverage AI, the consumer facing side?
I think you'll see them in innovative fintechs over the course of the next 2 to 3 years. I think it's going to take banks probably 5 to 7, mostly for regulatory and data integration challenges, not for lack of trying.
I think the dark horse that might negate my prediction in 25, though I think it'll be more likely to be really big in 26, is actually, Rex, you kind of touched on it, the Morgan Stanley OpenAI partnership. It seems like, just from what I've heard kind of in the press and from leadership teams in those places, like it seems like they were trying to make that a very big use case very quickly. What I've heard is kind of trying to build tools to give every wealth management advisor at Morgan Stanley the ability to give kind of best in class wealth management advice. So kind of internal tool, but it is like through the words of an advisor, still somewhat customer facing. So depending on how you count it and if that gets to scale, maybe that's my dark horse to negate my prediction.
Yeah.
So like turbocharging the humans.
Yeah.
Yeah. Versus just robo replacing them.
Exactly. Well, I mean, to be fair, I should not. I'm way over my skis here. I'm just repeating things that I've read in the press. So we'll see how it plays out. But
it's okay, Zach. The only thing it's recommending is Vanguard S&P index fund, and they're just making that recommendation over and over again. That's the way they're solving it.
Perhaps.
Most economists might agree with them.
Although now you can do direct indexing, which is more tax efficient. That's another question and topic, though. But yeah, I think the bull is that like they are actually doing it. The bear is these things are like pretty simple, but my experience, having worked at large institutions, it's amazing how much of the work that gets done is relatively simple and therefore potentially ripe for automation. Let's move on, though, Zach, to prediction 3.
All right, prediction number 3. This was pretty simple. Fintech funding is back, baby. I don't really say baby, but I mean, back, baby. But I think we're going to see kind of total venture investment in fintech and crypto rebounding to the, call it 2018, maybe 2019 level. I think from my side, I wanted to make a prediction that is like statistically verifiable. My other predictions are a little hand wavy, so this one's statistically verifiable. We'll see if I'm right. But I think the overarching kind of like backstory to it is that the fintech winter is over. It's fintech spring. Maybe it's not fintech summer quite yet, but it's fintech spring, which is feeling really good.
I agree. And some other just quantifiable things will be interesting to track. I think we had, depending on how to categorize it, 2 fintech IPOs last year. We also had acquisitions like Bridge, $1 billion by Stripe, Moneyline. They were public. It was another public company acquiring them, $1 billion. Bridget, $360 million acquisition. Those are the main ones. 3 is not that big of a list. It's going to be a bigger list this year. How big is that going to be? We'll see, but it'll be interesting to see. And then if we get close to Zach's prediction of 2018-19 levels, we're talking 200 billion plus of deployed capital into the venture ecosystem, which is where we high watermarked in 2022. So just some context, but I want to hear from other folks. Jen, agree, disagree, other thoughts?
I'm going to go with the meh. I mean, here's the thing. Like, great businesses and great ideas are always going to get funded. And I do think there are bright spots and emerging bright spots within the context of the fintech ecosystem and on the horizon. So like a lot of those are areas we've already talked about in terms of fraud and AI and the like. But honestly, I don't think 2025 is the year where it's going to rain VC cash. Like I might still be in that like icy sort of like early March phase where it's like still a little cold and like you're getting freezing rain. I think we're going to continue to see 2025 as a year of consolidation, and you're going to see the funding of some winning models. Like, I think the opportunity around fintechs are still shaking out, sort of where are we really seeing the pockets, where are we seeing the growth, where are we seeing companies that are companies, not products or features. There's been a heavy lack of funding for the past couple of years, and you're already starting to see some of that consolidation in the market. And I think you're going to start to see that as the economy kind of continues to recover and out of the crypto window. But like existing players with great businesses and ideas that have struggled are going to get kind of folded in, as you already alluded to, Rex, with some big deals that are on the horizon. I think we will see kind of ongoing kind of consolidation. And I think that'll continue.
Yep. I missed Trade PMR by Robinhood, $300 million acquisition as well. But Zach, I also have to say you are someone who to some degree has control over this with Plaid being an IPO candidate. So how are you thinking about that window? And then 2024, we did see some tender offers and liquidity via other means, secondary markets, that sort of thing. So what is Plaid's specific thoughts, plans?
Look, I think in the longer arc, Plaid is definitely on a path towards IPO. That is the plan. That's what we're operating towards. That will not be this year of 2025. That'll be 2026, maybe 2027. But sometime in that time frame is kind of what we're planning on. Again, answer definitively, but that is kind of the direction that we're headed, and the hopeful path. I think we treat an IPO as a very important milestone, but a milestone nonetheless, and we're much more focused on making sure that the business is in an amazing state for a long-term growth trajectory. In terms of tender offers and raising more money and things like that, look, we love the concept of having tenders for our employees, especially as we get later stage, closer to IPO. It started to become a thing that a lot of companies are doing, is kind of like annual or every other year tender offers for employees. That's something that we definitely support, but of course it's dependent on the market, and so we have to be sure that we're capable of doing that. But yeah, definitely a thought on our minds here.
And a lot of people, longtime employees, many companies, not just Plaid, they hit like certain time-bound things, 7-10-year vesting periods, Windows exercise stuff. So it's kind of the right thing to do. But you're also right. IPOs take a while. And so I would say, to go back up outside of talk about the ecosystem level, I think we are going to see a lot more IPOs, but 2026 is when they're actually going to start to hit, even if the planning kicked off 3 months ago.
Yeah, I talk a lot about it internally. I mean, this is obviously a frequent topic of conversation internally. I think there's 3 or 4 things that have to be right for an IPO to make sense. First is the company and the products and the growth rates and the financials have to be in the right place. So, financials have to be historical, forward predictive, and the growth rates have to be correct. So going into a huge investment cycle doesn't always make sense to IPO. Coming out of a huge investment cycle does make a lot of sense to IPO. Number 2 is the systems need to be in place within the company in order to do reporting correctly. And number 3 is the window needs to be open. It looks like the window is opening. We've seen, as you noted, some companies filing. We've seen some recent IPOs, and so that's really exciting. Now the question is, do all the companies that are thinking about being IPO candidates, do they have kind of parts 1 and 2 all set up correctly?
We went through get lean and mean, probably at the cost of growth over the last 3 years, and now a lot of these scale players are saying we're still going to be lean and mean. We're going to reinvest in growth. We're going to do new products. If you're Plaid, maybe that's Layer. If you're Gusto, maybe that's embedded payroll. So that's probably the thing you pay attention to as an audience is who's gotten lean and mean is reinvesting in growth and telling interesting stories about how they're going to have above market growth rates for many years.
All right. Regardless of where this prediction lands, I do think that we are going to see, with an increase in funding in fintech this year, we're going to see an increase in IPOs. I think we're going to see an increase in M&A. Especially if the M&A climate changes.
M&A much faster, easier to execute on. So I agree, 2025. Yeah.
And then the last one that I think is really important is we're going to see an increase in marketing spend by customers because, again, it's a lot of them have gotten healthy and now it's back to growth.
One other clarification too, the thing I'm most excited, I do mostly pre-seed and seed investing. We are already back at, and have been for 2 years, rates of company formation at the pre-seed and seed to 2020 levels. So we're already there at the early stage. It's just a question of across all stages and dollar amounts, are we getting back there? So I will say, it is spring, but it's been spring for early stage companies for a long time. Let's go ahead and jump into question number 4, which has to do with Alphabet and soups.
Perfect. Well, John, you didn't have a lot of opinions on the last one. I think you're going to have opinions on this one. So prediction number 4 is the alphabet soup, quote unquote, alphabet soup, of the Fed, OCC, FDIC, CFPB, and SEC will stay largely intact, despite the fact that we've heard a lot of rumors and statements about kind of getting rid of regulatory agencies or merging regulatory agencies, kind of like having them massively pull back. I think that for the most part in financial services, you're going to see the regulatory agencies stay relatively stable. I do think that a lot of the far-reaching, the long arm of the regulatory agencies will pull back, as you can tell with kind of a new administration coming in. But the focus on the core issues is going to be roughly the same, much as, So as much as I can try to predict the future here, that is my best guess, is that we will see kind of roughly the same regulatory agencies, roughly the same regulatory issues, though the reach will be maybe a little shorter.
And I think it's easy. Let's kick it over to John.
Yeah,
he
can I
is
jump in
DC, a former regulator, and while not allowed to talk to VCs, who do you get to talk to, John?
I get to talk to the entire alphabet soup. So I actually asked our team to put together a custom slide. I wonder if we could throw that up because this is critical to my answer. as you can see by my X profile, right? Like this is a chart created by the GAO, the single greatest government agency in the history of mankind. Everyone should give the GAO some love. This is the alphabet soup of all of our financial regulators in the United States and who they regulate. And this is my entire personality. You cannot take this away from me. It is already my X profile. So for that reason alone, we cannot do this and we will not do it. More substantively for the nerds out there, let's get actually into it a little bit, right? Like these are agencies that are created by legislation. It would require a massive legislative effort to reorganize them. Just saying the IRS doesn't exist doesn't get rid of the tax code. It just means there's no one there to enforce the tax code or collect the taxes. Same thing with the CFPB, Federal Reserve, CFTC, NCUA, all of them. So how would you go about doing it? Well, you're going to need to get past the Senate, which has the filibuster, which means you need a handful of Democrats. That's not happening. The only way you can do it is through a reconciliation bill. You only get 3 shots at reconciliation each year. It is already clear that the first reconciliation is going to be taxes and immigration reform. That kicks you into late this year before you can really try anything. It's not happening. What might happen that is more realistic and meaningful to everyone listening to this chat? So I do think Zach is right. You're going to have some real pullback on what is happening in the regulatory space, not necessarily enforcement actions. People don't remember that during the last Trump administration, there were actually just as many, if not slightly more, CFPB enforcement actions as there were during the Biden administration. So you'll still see enforcement. You're going to see a lot less regulation. You've already seen Vice Chair Barr announced he was stepping down from the Federal Reserve, and the Fed announced they were pausing all regulations until a new vice chair is in place. But much more importantly, because everyone, when they talk about regulation, 9 times out of 10, what they are actually complaining about is supervision. The banks having someone come in, or a fintech having someone from the government come in, evaluate what they are doing, tell them privately, we don't think you're doing it right. There's a lot of like stymieing of innovation that happens through that process. And it has gotten so bad that you've got a bunch of really key former regulators like Yellen McWilliams and Randy Quarles saying, you have to basically rethink supervision from the top down. It didn't stop Silicon Valley Bank from collapsing. It didn't stop Synapse from falling apart, but it is stopping a lot of innovation and new products in market. It is over-inclusive and under-inclusive. It is fundamentally broken. We've got to fix it. That is the main pain point that most businesses feel when they feel a regulatory pain point. It's that supervisory process. And I do think we are keyed up for a significant retrenching and rethinking of what that looks like.
Jen?
Yeah, how do I follow John Pitts on this topic? I'm just going to be like, see John.
I'll say, I think one agency, just to make some material statements about the agencies that will have the clearest impacts, because I think there, to your point, John, is a lot of uncertainty around how this will actually be operationalized. So one, the FCC pulling back, that will open the window to some of these M&A conversations, transactions. So that's one pretty material thing that's pretty material to the whole venture ecosystem, the early stage ecosystem. The other point about agencies getting deleted, that's really, really hard and probably matters less than how they actually conduct themselves in the wild. That's where things are going to change. The SEC is not going to go away, but the SEC's receptivity to crypto is going to dramatically increase under the new administration. So those are probably the 2 most material things. One is M&A because of the FCC. 2 is crypto receptivity because of changes at the SEC. But I do think it's interesting that if you look at Obama versus Trump, Obama is the only one who eliminated a regulator, and that's the Office of Thrift Supervision. Sure, it wasn't relevant. It didn't really matter. But scoreboard 1, Obama, Trump 0. So the point there is you have to actually govern, and it takes a lot of work to at least remove agencies, but you can maybe change the posturing and the involvement. John, agree, disagree with me, or Zach for that matter, on some of those thoughts?
So only 2 mild notes, Rex. One, I would say I agree with you on SEC, but I think it is possible the SEC doesn't even get to have an opinion on crypto 6 months from now because everything's going to be with the CFTC. So whether the SEC is receptive or not will be irrelevant. On the OTS, shout out to the OTS, man. I love that deep cut. It wasn't just Obama. It also required a small thing called the 2008 financial crisis to put the kill shot on the OTS. So like unless we get something of that magnitude again, knocking every piece of wood I can find, I do not see the likelihood of an agency elimination anytime soon.
Yeah. And thank you for all your work you do. I'm also glad we've got people like John in the ecosystem who can speak both languages, because that was in short supply not that long ago. Do we have a fifth prediction? Yes, we do. Zach.
I've got infinity predictions. We can just keep going, but at some point we will have to end this. But I've got at least two more. All right, so next one. So this one is around stablecoins. Stablecoins are the new hotness. They're all the rage. They're everything that basically all the VCs want to talk about right now, because of the Stripe Bridge acquisition. But my prediction is stablecoins will grow massively. But there's a big but in here, and it's not fully printed on the slide. They're only going to find deep use cases in two things, which is first is currency hedging. So people in places with currencies that are unstable, kind of hedging their currencies, or kind of hedging across different cryptocurrencies. And second is cross-border payments. Related to that, I don't think that CBDCs are gonna come to fruition anytime soon. And I think this is probably more than just a 2025 prediction. So I think like when I look longer horizon, cross-border payments totally makes sense. Currency hedging totally makes sense. But I'm not seeing those other huge use cases that will really drive stablecoin adoption. So
thumbs up on something related to the cryptocurrency space. I think the first time I did one of these, I told everyone that I have a fiat for life tattoo across my chest. But here I think we have a fundamental shift in the market and also the regulatory space, most importantly. And I would say, Jen, I love you talking about like the fundamental infrastructure part of this and what's necessary. I think the single biggest piece of infrastructure, and the piece that is, I think, going to cause this to really grow by leaps and bounds this year, is legislation and regulatory infrastructure. And I think it is likely that this year we see a cryptocurrency bill, and I think stablecoin is most likely to be the one that gets over the finish line into law. You've already got Senator Loomis and Gillibrand's bill from last year. That's a bipartisan bill on stablecoins. I would expect it or something like it to be introduced in the new Congress. And I think what you're really going to see is this consensus in Washington, D.C., that we need to pull this into the embrace of some regulatory framework. With this administration, it is going to be a relatively light, relatively innovation-friendly framework. And once you've got that framework in place, the number of traditional FIs that are going to say, actually, now we have a pathway to using this. We can use this in back office. We can use it for our own balance sheets. We can use it for bank-to-bank transfers. We can use it for a replacement for SWIFT, or at least an alternative. We can use it to start paying people more quickly. The CFPB just answered a petition recently to require banks to process checks more quickly. For God's sakes, year of the Lord 2025, we were talking about like processing a check in something under 3 to 5 days. Like, there is very clear use case for a liquid stable coin operating under a clear legislative and regulatory structure to take hold in the market. And I think once you have that clarity, you are going to see adoption by players who today feel like they are years away from adopting, do it in months instead of years. And that is where I expect to see the explosive growth coming sometime maybe fallish by the time this legislation goes through the process.
Interesting. So explosive growth outside of the two use cases that I named coming in the fall. It's spicy take, John. Also, regulation is going to accelerate adoption?
No. Yes, regulation can often accelerate adoption. Just think about, like you got to decide which side of the road everyone's driving on, and then suddenly you can put a lot more cars on the road than if everyone's driving wherever they want.
I will add something to the conversation too. I'm very excited about stablecoins. We should have had real-time payments in the U.S., call it 25, 30 years ago, and we don't. And we don't in part because the banks control every single real-time payment rail. They do it explicitly in the case. Almost every, well, you could, so I was going to say RTP by the ACH, that's like a bank consortium. FedWire is the Fed, but the banks are on the governing board of the Fed. It's kind of a bank-friendly, aligned institution. I know John is like shaking his head. It's not completely not true. That's not very reassuring. I should phrase it in a stronger way. But we need a better, this is 24/7, 365 real-time payments infrastructure that is built on top of what is essentially narrow banking. It's like a better financial primitive. and we've got a lot of work to do on ramps, off ramps. But it's actually something that can be integrated in and with and globally, not just within the US.
Rex, I just want to say that I really want to set up a scenario where I can help you prepare for congressional testimony with "it's not completely not true" as your answer to most questions.
Yes, thank you. So I'm a VC. I talk to founders and other investors. I don't talk to regulators. That's what I'm not allowed. I think that is a wrap for now. I'm just thinking about.
I have one more.
We have more,
but
we can't stop Zach.
I have one more, but before we get there, I do want to say we should have real-time payments. We should have had real-time payments already, in my opinion. Why is it being blocked? Yes, part of it is that the banks make money on interchange. Making real-time payments that are enabled on things like commerce would impact interchange. That is certainly true. So that's perhaps why RTP is not enabling commerce transactions. FedNow, though, again, that's controlled by the Fed, and the Fed does enable commerce transactions. The key issue there is adoption. And my hope is that, over the next, call it year or two, we'll see a lot more adoption of FedNow. Really getting that out there in the ecosystem will be huge. The interesting thing is that if stablecoins are adopted in a really meaningful way, especially for, say, commerce transactions, which, to be clear, we're not close to yet, but if they are adopted in a meaningful way, that'll put pressure on both. And so in some odd way, kind of stablecoin adoption for commerce would actually accelerate the RTP rails going faster and instant bank link payments. So we shall see how that all nets out.
And that's a great point. Even if you don't see as explosive of adoption, it's going to create competitive pressure to drive RTP on traditional rails, which is great for the consumer.
Last prediction from me. This one's a little out there. So basically, the prediction is that the big banks start to become advertising platforms. Again, a little bit of a stretch here, but if you look at kind of what's happened over the last, call it year plus minus, a handful of the banks, Chase and Bank of America, and then one of the fintech companies, PayPal, they've invested in kind of like building out ad analytics, ad platforms. If you look within your bank statement, you can actually see oftentimes ads right there in your bank statement. So, hey, you spent some money at Chipotle. If you spend more, like click this button and get $5 off your next Chipotle meal. So I think a lot of this is due to, frankly, the regulatory complexity and the costs associated with growing new lines of businesses, or kind of like, frankly, growing the banking business in general into kind of like new products. Maybe this is the trend that the banks are leaning on in order to kind of identify ways to quickly improve profit margins. So launching advertising products may well be cheaper and easier and less complex from a regulatory perspective than launching new kind of lines of banking business. So again, this one is a little bit out there, but the banks becoming the next fast growing ad platforms.
I'm going to go with kinda. I mean, like, part of it is like, I think about my own use case, and again, I'm not always the customer here, right? But like Zach, like I can't tell you that like I crack open my statements from my bank and I'm like immediately drawn to the ad section. Like that's just not what I'm expecting. And I think part of what's going to hold this back is really kind of the customer expectation of kind of what ends up happening, right? Because with advertising, like you make money when you show the right ad to the right user at the right time and they find a way to engage in it. And it's just like, are consumers going to be in that frame of mind? Now, that being said, like I do think there's some legs up that like banks and fintechs have in the space. Like oftentimes they have the default marketing opt-ins and they have the ability to get access to and work with a lot of that data. Although I'm sure I will pass it to Mr. Pitts and he will share some ideas on that. And then for some of the fintechs, like I can't blame people like PayPal for integrating ads. Like if you look at what some of the payment platforms need to do is they need to help merchants monetize their platform. And so, if they're able to serve alongside the ability to, buy something with ads or that are decreasing fees or whatever, like I think that kind of stuff is gonna happen. But I think literally cracking open my bank statement or cracking open my website to sort of pay my PG&E bill or check my bank balance, I think it's gonna be a while before that like takes hold. I mean, I think, just finally, I think the stats we're seeing on this, like I think that like eMarketer anticipates that financial media networks are going to be less than 0.5% in 2026. So I think, we're starting from bare beginnings. But John, I'm really curious to get your take, especially sort of on the sort of the privacy and the data use perspective.
Yeah, I'm actually a yes on this one. I think this is going to be a real growth. I know, shocking, because you would feel like there's obvious regulatory and privacy barriers to this. On the other hand, Congress has not passed a federal privacy law since the Gramm-Leach-Bliley Act of 1999. I was confusing that with Dodd-Frank Act, 1999. And most banks operate under GLBA privacy, which is not the strictest privacy regime in the world. And their basic business models involve a lot of cross-subsidization of free consumer products where those free consumer products are being paid for by some other line. And those lines are not necessarily as profitable or as large anymore. Look at what's happened with overdraft fees. So you're going to see that interest in cross-subsidization to maintain those things free grow and grow quickly. I think it's actually an area where fintechs need to be a little bit worried, because the harsh reality is regulators and government trust banks to do this more with data than they trust fintechs. And that means you are facing a real macro headwind where some of your competitors might have revenue opportunities that you are going to find harder to pursue than they will. And that might put you at a disadvantage if you don't figure something out. So I think this is going to come up. I think the only place where this might hit a wall is Chairman McHenry last year in House Financial Services introduced a very broad piece of legislation to really do privacy in the financial area. He has now left Congress. If someone else picks that up, I see it as a possibility. If no one else does, the only thing you really have out there is the CFPB's data broker rule. And honestly, I think it is unlikely that the new CFPB leader under President Trump is going to continue with that rulemaking. So I think you have a perception of a real regulatory barrier, not an actual real regulatory barrier, and the opportunity for banks to really pursue a business line here, and one where they will have a structural advantage over the fintechs in how deeply they can pursue it.
I'm going to disagree and align with Jen. I think they will want to do it a lot. I think it's going to be very hard to execute. I want to give some backward-looking stats and then talk about what it looks like forward-looking on a product standpoint. So Cardlytics peaked at about a $4 billion market cap in 2020. Cardlytics powers the B of A rewards thing. So they're that thing Jen is talking about. Is like you go into your bank statement, you can see a reward. Cardlytics today is worth about $150 million because it hasn't really worked historically for banks to try and push these offers. Now, there are other ways you can do advertising, but generally it's very hard for banks to do these high intent, high engagement, super frictionless experiences. I think they're just going to struggle. Like you walk into a store, you swipe a card, the proximity, like something that just pops up, it's elegant, it's in the moment, you do it, you get engagement. Whenever I log into my banking app, it's spinning wheel, and then another spinning wheel, and then another spinning wheel. And that's just, it has to be so fast. And so it's not that they won't get better. It's just, I don't think they'll be good enough this second time go around. I do think, though, if you want to follow one bank who's doing a good job, Capital One is doing some interesting things with shopping. Fun fact, shopping is actually Paribas. Paribas is Eric Lyman Ramp's first company that was then acquired and taken inside of Capital One. So who knows? Maybe one of them will be able to do it, but I do not think all five of them will be able to do something super interesting here.
Thank you for joining us, Rex, Jen, and John. I hope that you all enjoyed the predictions, the debate. This was super fun. You heard it here. It is Fintech Spring, and the flowers are getting ready to come out, and the birds are starting to chirp. Jen thinks it's actually like late, like early spring, kind of like spring skiing season, but I'm saying that the birds are chirping pretty soon. So thank you all for coming. Thank you for being here. My co-panelists, thank you for doing it. And we will see you all soon. Have a wonderful 2025.
Thanks, everyone.
Thanks all.